and test whether the alpha is indeed 0 in the data. And we use this basically to reject the theory at the end, because usually they are not 0. The alpha is used in many instances, in many other instances. For example, if you have, look at a portfolio manager, portfolio managers are often or their skill is often measured by looking at the alpha, right? So you would run this analysis based on the returns that the fund manager produces. And this part here of the return is the return that the fund manager earned because of risk taking, right? So the beta is a risk measure, right? So this is the expected return that you have from taking a certain level of risk. So everything that she's able to manage on top of that, the alpha, will be attributed to her skill. Right? So the alpha is a measure to identify whether fund managers are good or bad. Unfortunately, more than 50% have negative alphas, right? So they do not beat their benchmarks. It's a little bit of a conundrum, at least not after cost. The managers want to be paid, so costs are pretty high. Right? But that would be an application where you could use exactly this relationship, and the alpha would be standing for the skill of the manager. Because everything else of her is here explained by the risk taking, right? So that's the fair compensation for the risk, as measured by beta, and this will be any additional return, hopefully positive, that the fund manager makes. So I'm going to show you a method now to estimate beta and alpha at the same time. So I'm not quite sure how your statistics knowledge is, but I'm basically just showing it graphically to you. But of course you can run regressions also in Excel. I'm going to show you two ways in this session before the break. So there are formulas in Excel that you can use, but there's also a tool that you can use, like an add-in tool, which is very convenient to run regressions. So we'll have three different ways of estimating the numbers, and we're going to do this to cross-check that basically everything gives us the same result. So let's do this graphically, and I've mentioned already that I've prepared the example of BioNTech. So what do we see here? So this is a so-called scatter plot. So every dot here in the picture is a return in a certain month. And we put in basically two pieces of information to every dot. So on the x-axis, you see the return of the stock market index, the DAX. And on the y-axis, you see the return of the BioNTech shares in a particular month. Quickly open my notations because I've written down the numbers. Annotate this a little bit. So this here would be the DAX, and this would be BioNTech. So BNTX is the ticker symbol of BioNTech in the US. They're actually traded in the US exchange, but there is a co-listing in Germany, so I've used the German share prices. Again, something that you need to be careful if you compute betas is that you're in the same currency. Right? If you want to, for example, if you're a US investor and you want to compute the data from the perspective of the US investor, you need to translate all the returns of, say, a German stock using the appropriate exchange rate at that time. Right? Because there are changes in exchange rates, and if the DAX went up 1%, but the exchange rate went down by 1%, right, the return from the US perspective is 0. All right, so you need to always convert that in the same currency. So I've used data here from the Frankfurt Exchange, which is a co-listing. So there's not a lot of trading going on, but they basically look at what's the price in the US and they do the currency conversion basically. So maybe let's pick a couple of examples which are noteworthy, and I think the one here at the top left is an interesting dot. So this was basically the return of the market, which was minus 16.4%, and the BioNTech shares in the same month had a return of plus 66.2%. So you see that the overall time period here is November 2019, so that was the month that actually BioNTech went public, so they're the first listing, to April 21.
Really nice timing.
Yeah. So, exactly, I mean, the owners of BioNTech are billionaires today, right? So it's definitely good timing. So do you have an idea what could have happened in this month? So if you have to guess which month it is. Yeah. So why was that a bit bad news for the market then? So, I mean, we see the release of the vaccine in here, but do you think it's the good or bad news for the market when the vaccine is released?
It's bad news on the market, but good news.
When it's released, it's kind of good.
Yeah.
Kind of good news.
So the vaccine release is this one here.
Oh.
Right, it's good news for the market. So this was one which was very bad news for the market, but good news for BioNTech. So I can already put this in here. So vaccine successors in November 2020. So that's this point here, and we have plus 15%, and BioNTech has plus 40%. So that's one that we can identify. But how about this one here?
It may be the moment that maybe like the first cases where this of COVID were found somewhere like in the US or in some other place.
Yeah, it was not the first cases though, it was the lockdown basically, right? Because that made it very apparent that this is now serious. So the first cases were actually already discovered at the end of 2019, right? December. Right? But the lockdown happened in March. So this is March 2020. So very bad news for the market. The economy was basically at a halt. But very good news for BioNTech in that case. So these are, I think, the most obvious ones. Now, how can we learn something about beta from this picture? Well, this tells us a little bit about the relationship between the two assets, right? So suppose your asset is in the above, the dots are in the above sector. What does that mean? That means that the DAX is positive and BioNTech is positive, right? That would mean a positive relationship between the two. And if you were in the bottom section, the bottom left quadrant here, then you would have a negative return of the DAX and a negative return of BioNTech. And so if you see that most of the dots are in the upper right corner and the lower left corner, that must be a positive beta on average. Conversely, if you are in the upper left corner, so that means the DAX is negative but BioNTech is positive, or if you were in the bottom right, it means the DAX is positive but BioNTech is negative, that would hinge towards a negative relationship between the two, so a negative beta. Right? So at first glance, it's not really obvious, I think, right? You just have some dots here, but there are also these outliers up here, right? So we kind of have to average over this and account for this. So what do we do to figure this out? Well, we run a regression or like put the best fitting line through all the dots, right? So the red line that you see here is the so-called sample regression line. So that's basically the line with the best fit through the dots. Through the data points. So we don't have to dive into the technical details, but the method is called least squares optimization. So what you would do is you would take the difference to a hypothetical line. Positive, negative differences are squared again. Then you sum up all these differences and you try to minimize that. That's kind of your objective function. All right. So, and the red line here is the result. If you don't know how to run a regression, it's very easy to obtain the line though, because you just do this chart in Excel. And then you click on the right button of your mouse and you, select the command Add Trend Line, and Excel is putting the red line through the dots automatically. And there's even an option to reveal the formula for the red line, which is the result from the regression. So you don't have to know regression tools to do this. You just add a trend line in the picture, and that is already the line with the best fit. Right, that's how Excel was programmed to do. So, how does this line now help us to identify beta and alpha? Well, it happens that the slope of this line is the beta, and the intercept with the y-axis is alpha. Let me kind of draw this in this picture. So the slope here is the beta. You see that negative slope means you have most of the points up here and up here, so that's a negative relationship. If the slope was positive, then you would have most of the dots here and here, and you would have a positive beta. Right? And the beta equals 0 would be a flat line. And the alpha is going to be this intercept here. That's my alpha. So it's basically what return do you expect from BioNTech if you plug in a market return equal to 0? Right? What would be the return independent of the market? That's exactly this value. So we have a positive return, a positive alpha. I have the results on the next page, 16%, and the beta is minus 1.26.